Hi everyone, and welcome back to Market Insights, a series where we delve into interesting topics affecting equity markets. Today I have with me Cornelius and Jacques. Thank you guys for being here. So let's kick off with relative performance. Year to date, we've seen the MSCI Europe outperforming the S&P 500 by approximately 18%. This is quite a divergence from the performance we've seen in the past. Can you maybe give us some insights into what we're seeing in Europe at the moment?
Yes, so the market turned quite bullish on Europe. The outperformance over the US has actually been the widest we've seen in 40 years. Starting valuations much cheaper in Europe versus US. Prospects of two wars ending very positive. We've seen a commitment from Germany to loosen fiscal policies, which is positive growth, so that DAX is up very nicely. And there's also a commitment from Europe to spend more on defense. So shares like Rheinmetall up more than 100% over the last quarter. So we've seen European financials performing very nicely and shares like TBC and Halic, which we own the global and emerging market funds, performing very well. On the opposite side of the spectrum, the Nasdaq is down 10%. So very big divergence that we've seen, and we'll see how it plays out the rest of the year.
So building on that, we've seen a growing stagflationary risk coming out of the US, but combined with that, we've also seen a divergence in the performance of individual stocks and sectors in the US. Could you maybe help us unpack what's actually going on there?
Sure. So the March Consumer Confidence Index that was released showed the fourth straight month of decline, and we're now approaching the lowest level since 2013. And this is both confidence in current conditions, but also future expectations, while perception around the labour market remains soft, of course driven in part by Doge and possible further rate cuts. And this lower consumer confidence adds to signs that there will be a slowdown in consumption and then ultimately growth. And we're seeing the ISM and PMI numbers under pressure, while the Fed at their previous meeting cut growth outlook for the US from 2.1% to 1.7%. I think the risk around trade and tariffs brings uncertainty into corporate investment, while immigration has also seen a massive slowdown that adds to rising short-term inflation expectations and this nervousness around stagflation in the US. So looking at a sector level, the more defensive sectors like consumer staples have held up quite nicely, while sectors more geared to the economy like consumer discretionary was down 15% at one point.
We've seen US big tech down around 17% year to date, with the likes of Tesla down 35%. What drove this?
Yes, so the market turned quite bearish on Tesla. We've seen anti-American sentiment pick up in Europe and sales across most countries of Tesla vehicles down 40%. We've also seen some burning of Teslas in America, so that is impacting the stock. In context, the stock is basically where it was just before the US election and the rally we saw. On the opposite side of the spectrum, BYD is also ramping up their production and sales. The share's up 45%, and their battery electric vehicles are now exceeding Tesla sales. And if you add the plug-in hybrids, they're actually selling 3 times the level of Teslas. This is on the back of a superior value offering while giving you first-class technology. They also released an update that their latest vehicles can charge within 5 minutes. So just like DeepSeek challenged US exceptionalism with regards to large language models, BYD's superior battery technology and vehicles are now challenging Tesla, and we're seeing China doing more with less across various products. So Chinese stocks are still trading at a big discount to America. So for example, BYD is trading on a 19 times forward versus Tesla's premium rating of 88 times forward.
As most of our investors would know, we've been underweight the Batman stocks in the recent past. However, given the sell-off that we've seen, what are you doing to position the portfolios differently?
So taking a step back, I think it's important to remember that this Batman is just a collective term for some of the most successful businesses in the world. They used to be called the Fangs, then the Fang with 2 A's, then they changed to Fang Man. Magnificent Seven was in the news quite a bit last year, and now it's Batman. But it's key to remember that they've got very different business models and drivers. These stocks have derated considerably over the past 7 and 3 years to the point where we have the opportunity to buy them at parity ratings to the market. We still don't own Tesla, but we've used this opportunity to decrease some of our underweights and also further add into the names that we like, further increasing our overweights.
Thanks so much for the insights today, guys. It's been a real pleasure. Feel free to send us any questions or any topics you would like us to cover in the future. Also, remember to join us on the 10th of April for our Equity Explorer session, where we'll be delving into the US home builders. Thanks so much and see you then.